You might be doing it the hard way if you are buying individual stocks, nothing wrong with that, but there is a vehicle that can help you diversify your portfolio with just a click of a button. These are called ETFs. They're simple, they're diversified, and pretty effective even in today's market. And in today's video, I'm going to share some of the best ones you can buy in 2025. The aim of this video is to keep it smart, keep it simple, and more importantly, long term, so you don't have to play around with them too much. Now hit that like button if you are wanting to build some long-term wealth, and also comment which ETF are you holding, if any. But before we dive in, we need to talk what is an ETF. And this is the thing, it's hopefully this is in plain English, but an ETF stands for an exchange traded fund. Think of it like a basket of investments. So think of it like your bowl of cereal, you're putting your Rice Krispies into a bowl. They are all your individual companies. They can hold dozens, they can hold thousands, they can hold bonds and stocks or whatever, all in one place. So essentially you got a bit of slice of everything in terms of multiple sectors and multiple weights. It stops it from being volatile. So, for example, a global ETF will have the US, the UK, Japan, and other countries involved. And they also trade like the stock market valuations, and they do fluctuate up and down. But more importantly, most of these have lower fees. So it kind of works for the long term sort of vibe. And more often than not, if you hold for 10 years, you're going to win with an ETF. So let's look at the core holdings, the global index ETFs. Now, I'm going to talk about my own portfolio in a minute when I get to a certain point about dividends, but you should have a fund like this. Mostly pensions, funds like this, usually. So the first one on the screen here is the ticker FTWG, which is the Inversco FTSE All World. This is all the stock. Now, this has got the lowest fee. It's got 0.15%, which is quite low, and it copies and covers over thousands of different companies worldwide in one ETF. No need to overthink it. Just set, forget, and build wealth over time. And performance-wise, these do pretty well. There's two I want to go through. But more importantly, as I say, it's a distributing one where essentially what's going to happen is it's going to distribute the cash to you, which is quite nice. And it does include dividends, but the dividends in these sort of funds are quite low anyways. It's not the sort of thing you'd go for. But well, you would, but you wouldn't go for it for the dividends, if that makes sense. The big thing with these is the proven because it's a bit of everything. If the stock market goes up because of certain parameters, this will go up. So traditionally, you could argue money goes up with the world in terms of money flow and obviously inflation and stuff. So it's kind of an obvious one, really. And the second one is actually the Vanguard one, which is the all world ETF. This is just the accumulating one, but you can get the idea. You can get either distributing or accumulation. It's entirely up to you. Now, for me, fundamental wise, this one is a pretty solid one. It's been around a bit longer. Obviously, you can see that. And these are other versions of this as well that you can go on. But the main caveat to all of this is as a global exchange fund, it will be the whole world. And as you can see here, United States, Japan, United Kingdom, China, whatever, decent weights, and that's the thing, different sectors. So it's a bit of everything. And overall, the performance has been pretty damn good, realistically. So not bad at all. And I said core holdings, potentially some of these. So let's talk about the S&P 500 ETFs, which are quite obvious. Again, this is to top up your core US exposure. Now, these are on the London Stock Exchange, so you can get involved in these as well, which is totally fine. Now, you do have distribution and you do have accumulation. VUAG is the accumulating one, but again, the fees on this 0.07%, which is pretty damn good. And you do get dividends, but it's only about 1%. You wouldn't really use this for dividends anyways, but personal opinion, it's a really solid one. You can see overall, the size of the fund is relatively big. And going up to the top holdings here, most of them US, most of them the obvious players in the world, but they are pretty good and quite tech heavy, but there is some financials and consumer stuff in there as well. But overall performance, pretty damn good, and you would have made some decent money. And even when we talk about like overall core distribution of volatility, here we go. Since inception, the max drawdown you could have been in is 26%, which isn't too bad considering. But if you held, absolutely fine. And another S&P 500 one, this is quite an obvious one, but 0.05%. This is an accumulating one. But ultimately, as I say, this has got a really low fee, which is quite nice. And its performance is pretty good. Again, you could argue a lot of things regarding performance, but as you can imagine, pretty damn good. You can't really go wrong with that. And yeah, similar sort of vibe. It's obviously the S&P 500. This one's been around a little bit longer, but I do feel that the Vanguard ones are more popular. So yeah, if you just want some US exposure, and these are the obvious, the elite ones, the low cost ones, great returns over the last decades or so, but obviously be aware of over allocating if you already hold a lot of the global ETFs. So maybe worth making a decision. How much weight do you want to do in the S&P 500s or the global ones? But both of them pretty good for your core holdings. Now let's talk about dividend ones. Now this is good for the passive income seekers, the higher yield. Now the reason why I did a change in my portfolio recently was I wanted an ETF. I've done another change yesterday and even today because I was researching this video and I thought I could have a bit more here and a more UK focused high yield one, which I will come on to. But this is the one that I have currently in terms of my portfolio. So I've got two. This in, as you can see here, it's the global dividend aristocrats. I can't even say the word, sorry. And this essentially is all the top dividend stocks that are still paying dividends that have been for over the 10 plus years. There's only 98 in here though. That's the only downside to it. But as you can imagine, these are all companies that are actually really, really solid in terms of consistently paying dividends. The performance of this is pretty good as well over the course of time. You can see it's not too bad at all. It's a lot lower than the global funds, but ultimately you don't want to have the crazy volatility with a dividend fund. So if you're getting the passive income, it's awesome. And the dividend has gone down a bit over the last few years, but ultimately right now it's still 2.72%, which isn't too bad at all. It's okay, but it is slowly rising, which you can see on the monthly dividends here. Now, as you can imagine, the volatility is a little bit lower than the global funds. Obviously, with COVID, it went a bit wrong, but as you can imagine, it isn't too bad at all. And the max drawdown on these are actually quite good considering there's a lot less weight in them. So one of those ones which are quite useful for your dividends, and as you can see, it's quite an obvious one if you're looking for your passive income. And I've just added this one into my portfolio. Now this is more UK based. It's pretty much all the UK. It's focused on high yield but quite quality in terms of stocks anyways. Actually performance over the course of time has actually been relatively good, even over the course of like the past, and I'll show you this here. So most of them in the United Kingdom. You can see the obvious ones here. Some of them are a bit wishy-washy in terms of individuals. You wouldn't want to have the individual, but the weight of them are quite small. It's not too bad, so it does make it a bit better. But overall performance isn't too bad at all, realistic, when you look at the grand scheme of things. And you can argue a few things here, but even either way, like there's still some really nice numbers here considering it is a high yield dividend fund. So it's not terrible, but the dividend yield currently is 5.16%, which is pretty good. So it's been pretty, over in my opinion, pretty good one to have. Certainly if you're in the UK market. And either way, like yes, there's some volatility here, max drawdown here, but overall in the last couple of years, it's not real difference versus say the global funds. So it's not bad at all, and you get paid, which is quite nice. And the last one we could talk about realistically, now this is quite obvious. This is basically the FTSE 100. This is just the equity income index essentially, right? And this one's another one that's got decent performance. It's still doing pretty well. There is a dividend here. There's quite a decent fee on this. It's quite low fee versus the other two, right? The other two you probably know is quite a high fee. But again, you talk about some pretty solid stocks here. The top 100, basically in the UK pretty much. HSBC, Shell, AstraZeneca, you get the idea, right? But the performance of this has actually been really, really good and really, really solid. And it kind of makes you wonder, wow, that's pretty awesome. And even the dividend yield of 3.27% is actually really good. So I'm in two minds here. I really am. I'm thinking, do I stick 100% UK and bin off the first dividend ETF, which is a bit more US based and just more about the longer term one? Or do I look at this one? Because this one, performance wise, actually been really, really solid. And as well, like look at the overall, index of the volatility, not bad at all versus what you'd imagine in other markets. So certainly one to keep an eye on, but as you can imagine, that could well bring my yield up. So yes, I am genuinely thinking I'd just swap one out and move it around. I do believe in my own portfolio, even a 70-30 split of 70% of them individual stocks and a 30% of them ETFs or a trust fund is probably quite a good split for a growth fund with high dividend yield, with growing dividend stocks as well. It's good to have, but the core element of some of the bulk of the money in bigger funds that will pay a dividend is actually pretty nice, and that will take the weight of it as well. So yeah, as you can see, these do work pretty well if you want to grow a bit of income and a bit of compound over time. But remember, high yield isn't always high quality. But one way to get around this in a way is to have it in a bit of an index where, if one element gets smashed by a poor income score, or dividends been slashed, or whatever it may be, earnings miss, it kind of helps. Let's talk about emerging markets. Now, this is a bit more long-term growth, a bit more risky, but ultimately emerging markets are pretty useful in terms of growing your portfolio because sometimes you get exposure in the likes of India, Brazil, China, where they outperform markets in the long run, and it does give you a bit of a broad kind of exposure level, but you've got to be a bit more patient with these. And overall, they actually do all right. They don't pay massive amounts of dividends because some of the countries are quite emergent, so they don't, they're not quite there yet. But some of them do, some of them don't. But you can see already the fees of it not terrible, decent size, decent amount of stocks. That's the main thing. But when you go to holdings here, China, Taiwan, India, Brazil, financial, technology, consumer, telecommunications. Some of these you may never have heard of. Alibaba you probably have and a couple of others. But, overall, performance, not terrible. Dividend yield, okay, 2.53%, not bad at all, which isn't too bad. But there has been a couple of losses in terms of dividends. So they're not really consistent. But as you can imagine, over the course of time, not too bad. But realistically, we'd look at the risk and the volatility here, not as terrible as what you'd make out with emerging markets. So definitely something for exposure. But yeah, it's one of those where you need a little bit of luck, a bit of timing, but a bit of time, you'll be all right. Now, let's turn up the steroids a little bit. Great for small speculative allocations. Small is the key word here. Now, this is the iShares Automation and Robotics. Now, I picked 3 random ones just because it's kind of techie. And this is all about 141 holdings based off automation and robotics, right? It's very, very straightforward. Higher fee, okay, fair enough. But the performance hasn't been terrible, right? But you are kind of betting on the future a little bit here, right? In terms of if you believe in a trend or whatever it may be, and you want to have a bit of exposure, whether it's technology, industries, whatever, this is sort of the one you kind of want to look for. Now, again, as you can imagine, you will get some cyclical kind of moves where it may be a bit mental, but you can see the risk element of it. The volatility is a lot higher here. So, yeah, there's a bit of a trade off, but you might make more returns on one side of it. And again, we could talk about artificial intelligence. This is kind of an obvious one if you're into AI. This is the legal and general one. It's quite a high percentage fee, but you may be paid off with the world of like a narrative around AI. And performance has been pretty good realistically over the course of time. And as you can imagine, there's some really interesting stocks that you probably would have obviously heard of. But the reality is here, you may well see some pretty horrible months. And you can see overall here, some months are pretty horrible, some months are pretty good. It just depends. But over the course of time, it hasn't actually been too bad, but the volatility is so much higher. So be mindful of that. And, it might well be a chart that is, up the stairs, out the window pretty quickly. So just be mindful of taking profit on some of these funds as well. And the final one is kind of an obvious one in terms of the news currently is semiconductors. If you know about, Donald Trump putting little tariffs on semiconductors and stuff like that, this is the reason why I picked it. Again, volatility could be pretty high here. The overall chart of it's pretty decent over the course of time, but overall you got to think of the inception dates of these quite low, and that could be a bit of an issue. But yes, you do have the likes of Nvidia and AMD and quite cyclical in terms of like the fact that they've really pushed up recently. But overall, the performance has been pretty good. However, that being said, will this continue into the future? I don't know. Volatility, as you can imagine here, pretty damn big, 40% volatility. So quite heavy risk realistically. So be mindful. But ultimately, yes, it's exciting. Yes, you could have a lot of people putting a bit of allocations in a small part of your portfolio. That could be quite nice. But ultimately, you got to kind of be in the know a little bit. So in terms of picking an ETF, and I know in the comment section I've already missed a load. You could probably see the NASDAQ. Yeah, woohoo, I missed it. But I will showcase something in a minute. But one website I do recommend is just ETF. It's really, really easy. And if you are in the UK, you can buy a lot of these anyways on the London Stock Exchange, which is fine. Now, in terms of how to pick the right ETF for you, there's a couple of things you need to look at, and I'll kind of talk through it. Now, the first and foremost, if we're going to go EQQQ, which is this bad boy, which is the NASDAQ 100, right? Which is fine. And I do recommend it. And again, add it to your list. But the reality is here, you need to look at each individual one. If you got a lot of S&P 500 stocks, if you got a lot of global fund ones, having as well the NASDAQ, you've got to kind of look at certain things. So look at the fees. Which fee's better? Considering you're going to get a lot of weight based off this as well in your ETF. Is it physically replicated? That helps too. What is the fund size? Is the fund big enough? You need that as well. And also, is it doing what it says on the tin, right? Realistically, you got to look at that. But also, as I say, make sure you can buy it with the London Stock Exchange, which I will showcase on Trading 212 in a minute. Now, again, we could talk about this one. Performance relatively good, decent size, decent, well, kind of enough in terms of funds, a fee, sorry. But again, you're going to get a lot of stocks here that are on the S&P 500. So probably make a decision because they do move very, very differently. And obviously, yeah, you could argue a couple of things, but the dividend yield is quite low on this as well because it is technology. The volatility, it's very, very up and down. It's pretty cyclical at certain points. So just be mindful. But if you go into trading 212, up to you how you want to do this, but if you go into like equity ETFs or even just overall ETFs, you can see a lot of stuff here. So the ones that I've been covering here, obviously the FTSE 100's there. You know, you got the all world one there, right? So there's a lot here, right, you can look at. And they have further information. If you scroll down, you can just see all the information of other pies and stuff like that. So it's quite useful. So in terms of picking them, they are very, very, very straightforward. But ultimately, what I will say is this: if you look at the community side of it and see what the most popular are, obviously the S&P 500, obviously, is one of them. You know, the whole world, as you can imagine, you know, different ones in the S&P 500, the iShare, all they're all here. That's the beautiful thing about it. And obviously, as well, it's up to you. But there's also a website below called Invest Engine. You can get some free monies there. That is all exchange fund sort of elements around it. And I will be doing a full-on video deep dive on how to work Invest Engine in the next couple of weeks. But if you want to keep it simple, they're all here. So there you go. Sprinkle a little bit of an ETF into your life because it kind of makes sense. And if you want to do it, in my personal opinion, look at the global ones and build that as your core one and then branch out, add a bit of income, add a sprinkle of growth sector that you may be interested in. Now, I just gave 3 examples of different sectors, but there's so many different sectors. It's crazy. You can go on to just ETF, you can look at all the information, you can look at the best performing, the worst performing ones. There's narratives in there as well. It's absolutely crazy. So yeah, don't just chase returns, just chase the consistency. It will help you. And like myself, I have a sprinkle of these in my pension fund, which is quite nice. So I do have exposure there. But ultimately, in my own dividend income one, it kind of makes sense having the obvious ones that will pay a dividend yield that spreads out the risk so it's not as volatile. And it takes a lot of the weight off it in terms of the individual stocks. So I don't have to keep an eye on them as much because they're lower weight, but they will be more cyclical and more rewarding longer term with staying consistent. So yeah, let me know which ETF are you following or have you had for a while and what sort of returns you've been getting. It'd be nice to know. And I want to say thank you to all the subscribers. We've hit 1,000 subscribers in the first 18 videos, which is quite nice. So yeah, I'll see you in the next one.